Hello and welcome to the Mutual Fund Show. I'm your host, Neeraj Shah. Well, lots has happened in the year 2020, of course, and as we draw the year down to the close, I think there are some important developments that are happening currently. Franklin Templeton and the whole case is, I reckon, in some form in the courts once again, and I think the hearings adjourned till January. Mutual fund flows, and arguably, we've seen the largest outflows from mutual funds in the month of November 2020. This is the data that came out yesterday. The methodology was changed somewhere in 2018, and therefore we do not know if these were the highest outflows ever, but safely presume that these are the highest outflows ever. So that has happened too. And of course, 2020 is seen just the ebbs and flows which you would normally see over a period of 2-3 years happening in a period of 6 months. So lots to talk about with our guest on the show, Ashish Somaya. It's been a while that we've had him, and in his new role as the CEO of White Oak Capital, he joins us for the first time on Bloomberg Quint. Ashish, really good having you. Thanks so much for joining in.
Thank you for having me, Neeraj. Nice to see you.
Likewise, lovely to see you. Now, before we get Ashish's views on all of these things, let's start off with the burning topic at hand, which is the flows. And let me get in my colleague Nikki Mirchandani to come in and speak about what exactly happened when it came to November flows and how can one dissect each category. Nikki.
Evening, Neeraj, and evening to all the viewers out there. Equity flows have remained negative for a sixth successive month that we've seen for the month of November itself. They've, at that point of time, record level of around 15,450. This comes despite the fact that the markets have been doing extremely well. Look at the Nifty chart, almost 11%, 12% kind of uptick that we've seen in November. Nifty mid-cap also has rallied more than 15%. In fact, if you see the kind of record that we've seen in terms of the outflows coming in, all the funds or all the categories rather have participated with this, but the maximum participation when it comes to outflows is rather coming in from the large cap and the multi-cap category, which of course have accounted for the major portion of these outflows. Surprisingly, large cap and mid cap, if you compare the contrast in for the month of November as compared to that we've seen previously for the last 2 months, there is some amount of inflows or rather some amount of resilience which has been seen by these funds. But in this month also, they've succumbed to some amount of selling pressure clearly, which has come in on these funds as well. So reacting to that, we've seen all the categories actually witnessing some amount of outflows. And I'd also like to highlight the fact about SIPs because we've slipped to the lowest level that we have at least since April 2018, where they stood around 7,320 odd crore. We saw some growth coming in October. That came in after 6 straight months. It looked like it was aberration of sorts at this point of time because, November month, we've seen, again, the SIP going down, the growth going down at this point of time and standing at a level of around 7,320 odd crore. Overall, 7.2 lakhs SIPs were closed and around there was an net addition to an extent of around 3.4 lakhs overall. Back to you, Neeraj.
Yeah, well, thanks for that, Nikki, for slicing and dicing that data. Ashish, let's start off with this because, in a manner of speaking, the knives would have been out yesterday. But that notwithstanding, what do you make of this number as well as the last 2 or 3 months numbers?
See, I think that a lot of focus actually goes on the net flow numbers, which just for clarity is sales. Inflow minus outflow or sales minus redemption. Now, I personally find that the net flow numbers can be a bit misleading. And we should always look at the inflow separately and the outflow separately. So in the November numbers, Nikki clearly mentioned, approximately 13,000 crores of net outflow from equity mutual funds. And if I were to add the categories, which is, balanced and aggressive hybrid, which are also predominantly equity oriented funds, in fact, the picture gets worse. It's about 17,000 crores of net outflow. Now, look at March, okay, the bottom of the market. March was 9,000 crore inflow actually. So the general assumption is that investors have become very mature because in March, when the market bottomed out, we had 9,000 crore of inflow. And in November, when the market is making a new peak, we have 17,000 crores of outflow. So people are kind of buying low and they are selling high. Now that, according to me, is an oversimplification because different set of people are putting money and different set of people are removing the money. That's the first point. The second point is that in November, we had only 17,000 crores of inflow, but we had 34,000 crores of redemptions. This is November. Do you know in March what this number was? In March, we had 25,000 crores of outflow, but we had some smart cookies doing bottom fishing. So we got about 34,000 crore of inflow. So what does it tell you? The difference between March and November is that in November, people don't seem to have much faith in this rally, and a lot of people have stopped investing. In March, there was bottom fishing. That's the inflow side of the story. But the outflow side of the story is quite crazy, because November at 34,000 crores of outflow, which is the highest outflow, like you rightly mentioned. But do you know which was the second highest outflow? It was March, 25,000 crores. So, I think that two readings in this. One reading is that people don't have much faith as far as this significant upside we are seeing in the last few months. I think people are quite skeptical about whether this will sustain or not. That is one reading. And the second reading, as a result, there is withdrawal and there is not enough inflow. That's what it actually shows you. And the second thing, actually, if you ask me, is that in my past experience, I have seen that whenever there is a big decline, people do get scared. Some people might want to withdraw, but they don't withdraw. But moment that, first the 100 becomes 70, and when 70 becomes 95, 98, 99, then people really want to bolt for the door. So these are the two things that I'm observing right now.
Ashish, could a case also be made for some, how do I say, not introspection really, but change of strategy or expenses or something like that from the mutual fund side as well? The reason I bring this point up is that if I look at some of the smaller funds which have done well in the recent past, at least, or the last couple of years or 3 years or whatever, I somehow see a pattern there wherein their AUM and their flows are not getting impacted as much. Maybe it's a factor of size, I don't know. But there is a bit of a pattern that the funds which have consistently done well for the last 3 years, and there are a few houses which are doing that, and maybe they have the advantage of size, as I said, but their inflows and their AUMs are not getting impacted too much. So could there be some bit of rethinking about, or the approach around how mutual funds would have done well? Because as much as I agree, Ashish, that people should not be getting out in rallies, because these rallies might actually continue and you stay invested for long. It is a fact that for a lot of people, their SIPs, even SIPs over 3 years, are under the water.
No, so I think one is at an industry level, on your first part of the question, I think at an industry level, what needs to be really thought about, I mean, I'm part of the industry, we all need to think about this, or need to introspect, like you mentioned, that what is the real understanding vis-a-vis SIPs? Because actually, if you really ask me, if you're an SIP investor, then when this, February, March, April, May, June, when this entire phase kind of played out, if you're an SIP investor, then you should have been happy, because that's the whole concept. See, SIP works really badly for you. If the market keeps going up, you're consistently averaging up, then what's the use of doing an SIP? But SIP is supposed to work fabulously exactly when 2020 kind of scenario plays out. And if that has not encouraged or enthused people to commit more, then I think, clearly, what are we communicating about SIP? How is it supposed to work? What exactly does it do? When does it benefit investors? I think clearly that is something to be thought about. On your second question, related to not so much about large funds or small funds, at least in my perspective, I would say that, anybody whose performance has not been very volatile, let us say, for example, if you're top quartile, in falling markets, you don't fall as much. Yes, then in rising markets, you may not rise as much also. But somewhere I think investors are kind of communicating that it's not about the highest return. It's about as low volatility as possible. And second, I think, is also about, being true to label. Like, for example, one of the categories which I have mentioned to you in the past also, and which I track quite closely, is balanced advantage funds and hybrid equity funds. And these funds were actually supposed to have lower volatility, and they were supposed to actually shield investors from negative return. But if you actually look at it on a per capita basis or size of AUM relative basis, the category which has highest outflows is this whole balanced advantage and hybrid equity and dynamic kind of category. The reason being that in certain cases, they have done as badly as equity oriented funds. So it's two things. I think one is about volatility of performance, and second is about certain expectations being belied. I think that's where the issue is. It's not all about small and mid cap and stuff. It's also about true to label, some expectations getting belied, and at the same time also volatility.
Yeah, well, let's see if an average investor comes out of this smarter, because maybe people learn from other people's experiences, and all those who've gotten out, and the presumption that they haven't gone to equity markets directly, and therefore may have a left out feeling come May or June next year when they see some of the others and their funds having done
That's
well.
that's actually the fear. That's actually the fear. Look, in stock markets, in equities, at least in my understanding, if you spend 3 years and in those 3 years you've not see, equity returns are non-linear and they are lumpy. So if you've stayed put for say 3 years, in those 3 years you don't make any return,
and you've gotten out.
and when your capital comes back, you want to bolt for the door. So what it means is that you lived through the worst, and just before a good phase starts, you kind of given up.
Yeah, that's true. But yeah, which I said, I hear some stories of people having removed money from the mutual funds and got into direct stock investing, and good luck to them. I hope they can do well, really. But if they haven't, and if they see the neighbor doing well or the friend doing well because he was invested, that might be a case of sour grapes.
Yeah, so there's a fear there, which is that, look, if you, for example, in April 2020, your 3-year return, 5-year return was abysmal or negative, or your SIP didn't look like it was performing. So in April or May this year, you make a conclusion that, oh, mutual fund didn't do too well for me. And then you go and buy some stock. And now in November, you're drawing a conclusion. Then you're really going to mix up skill with luck. That's the whole point.
Yeah. We actually did a show around this with I think Kuvera, wherein they brought out the same point as well, and they compared the probabilities of this happening. But yeah, that's a good insight, and thanks for that, Ashish. So that's the word, viewers, on flows, and at least the view from Ashish Somaya. Now let's get on to the other pieces. One thing that I think everybody would be happy about, Ashish, individual investors and fund managers alike, and at least the ones who have these PSU names within them, is this no, I wouldn't say sudden change, but a slow change in the fortunes of the PSU stocks, arguably because the policies of the government seem to have changed a little bit in the way they are approaching the divestments and the fundraising in these PSUs. Now, there in past have been complaints by a bunch of fund guys that the government, something has to be done to arrest the slide of the PSUs. What's your sense now? And therefore, do you have any opinion on people who would be invested in PSU funds or CPSE ETFs, etc.? Do you have any thoughts there?
Yeah, look, I think it was Mr. Jain or one of the highly respected investors. I think it was Mr. Jain who made this comment that if you're going to consistently look, if it's right out there in the open that you are a seller. That's the worst position to be in, right? Who in his right mind, who is a seller, goes around announcing that in the next 1 year, 2 years, 3 years, at all points in time, I'm going to be a seller of this stock. That's not going to augur well for the stock price at all. So there has to be some smartness about how the disinvestment happens really. And I'm saying this purely as a taxpayer, if you will, because we have no exposure to PSU stocks, no vested interest of that sort. But it's a simple submission that, like I think Mr. Jain commented in one of the media articles, that your selling plan should not be out there in the open, and there has to be a better way to conduct this, purely so that the best prices are realized on those sales. That's very, very simple. And the second important point is that you would like to sell an asset when it's in the best possible condition. So let us say some kind of sell down happening from Suti, maybe that makes sense because they have certain good assets, and there has been price recovery. So I think the strategy really needs to be rethought. Is how I would actually put it.
Yeah, you reckon some of it has been done, and which is why maybe the holders of such funds or the managers of such funds would not be as worried a lot. The last few months are slightly different.
There seems to be, because that whole on-tap CPSE ETF kind of thing, I think that surely was doing harm. And, in all of those issuances, what was happening was you could clearly see that the corpus just dwindled. So people were scraping the dividend, and then immediately all the stock was being released in the market. I think there seems to be some rethinking out there, and, that's not happening anymore. So that's, I think, a really good thing to happen. And the second point is also, I think the timing and, when is it liquidated and how it's liquidated. I think all of those things need to be reworked. So I think there seems to be some improvement or rethinking, which seems to be evident. And the second important point is also the fact that, somewhere I think the economy seems to be turning a corner. I used to think like this in 2019 end also. And, COVID clearly put paid to those efforts and thought processes. But I do believe that, and it always happens with very low interest rates and very high liquidity, plus benign macros. So if the economy is kind of beginning a new cycle, then it augurs well for some of these enterprises, is how I would put it.
Well, for people who are in some way connected with the CPSE ETF, I must say I have the absolute returns as of the NAVs as of yesterday. 1 month returns were about 16%, 2 month returns 23%, and 3 month about 12%. So it's not been terrible. I must.
There's an improvement. Yeah, there's an improvement.
There is a bit of an improvement, but I think Ashish's point is well taken. Okay, Ashish. So let's the final piece of the conversation today, and that is about how 2020 is taught all of us more lessons than any other year, at least until 2008, or maybe more than 2008 too. What stood out for you as both from a perspective of a mutual fund manager of sorts? I mean, one who's in the industry on the other side, and as well as a mutual fund investor.
Yeah. No, so so for me, what I consider is a great part of my job. Sometimes it's the most difficult part of my job, but sometimes it's also the most educative part of my job, is obviously interacting with investors. And I personally have been interacting with a lot of investors over the number of years. And 2020, from that perspective, has been a reasonably tough year, because when 23rd March, 26th March, when 7600 Nifty suddenly appears out of nowhere, then I think, logic and rationality and, logical explanations don't seem to kind of always work out. So that's where things become difficult. But I can tell you in terms of learnings, few experiences. For example, I'll share more like a case study with you. I interacted, and, this is an example or a case study of one client I interacted with, but I suspect that it happens with a lot of people. So there was somebody who invested somewhere in 2015 March. Okay, so if you remember, 2015 March was 9,000 on the Nifty. And Feb end of this year, when 5 years were over, the investor had a return of about 12.5 to 13% compounded. Some 4-5% CAGR ahead of the Nifty 500 index, TRI index, and 12 to 13% compounded on a 5-year basis. Now, when this person spoke to me in the end of March, obviously he had forgotten what was happening in Jan, Feb, etc. But end of March, he was quite shaken up because the 5-year CAGR was 4% compounded. So his obvious grievance was that, what is long term and what is this 5-year? It's complete nonsense. It just doesn't work. I should have kept my money in the bank. So what I did was I pulled out statements of various dates, and I explained to him that, look, you finished 5 years in February. In February, you were at about 12% compounded. In the month of March, the index and the markets, and, and if you remember March, it didn't matter what you're holding. Everything was just kind of collapsing. So I just explained to him that in February, you were at 12% compounded return. And in the end of March, there is a 35 to 40% decline. So if there is a 35 to 40% decline, it means that your 5-year CAGR declines by 7 to 8%. And, so his 5-year CAGR looked like 3.5 to say 4.5% at that point in time. And he was really upset with his investment. So over the number of months, I had to kind of handhold and ensure that there is no quest for a redemption, because, there was this belief that, I should redeem, this just doesn't work, might as well put money in the bank, etc. And that's when people start to lose faith. Look, one of my learnings, which I always tell investors, is You don't need to demonstrate faith when Nifty is 12,500. You need to demonstrate faith in this concept of equity investing when Nifty is 7,500. Faith and belief is required at that time. When money is double, everybody has faith and belief. It doesn't matter really. So now I'll tell you the travesty. This person has withdrawn in the end of October. So at end of October, the 5-year return had improved from 4% to 9.5%. And the sad part, if the person had waited till end of November, the 5-year CAGR would have been more like 12 to 13% compounded. So 2 or 3 learnings in this. One is faith and belief are needed at the bottom of the market, not at the top of the market. Second is all this greed and fear and Warren Buffett statements that people pin in their softboards in the offices. They are relevant when Nifty hits 7,500, not when it hits 13,000. And the most important thing is that equity returns are non-linear and they could be lumpy. So if you told somebody in March that, look, don't panic, you will make this up, because just like you can fall 30-40%, there can also be a point where you can gain 30-40%. But people are not able to visualize that how can that happen. But I think it does happen. That's what 2020 has shown. And equity returns can be non-linear. So I think we just need to stay put.
Yeah, let's wrap it up with this final point, and which is full of optimism, which is, if you're not optimistic, equity is not for you. I don't think there is a better point than that for an equity investor, at least.
Yeah, I mean, if you generally believe the world will come to an end, then you should not be investing, right?
In anything, let alone equities. But yeah, I think that's a very well taken point. Ashish, it was a pleasure talking to you today. Thank you so much for being with us on the Mutual Fund Show, and all the best for 2021.
Thank you for having me. Thank you. All the best to you and the viewers. Thank you.
Thank you. And viewers, thanks for tuning into this leg of the Mutual Fund Show.